Hey everybody, this is Kevin. Hope everyone is doing great. Had a happy 4th of July. Today I'm going to be going over the second quarter data that's come out concerning the markets. But as always, the major reason why we do this is to talk about the discipline it takes to be an investor, try to ignore all the news, how diversification can work, and sometimes how it is painful, and just take some messages that the markets give us. So the messages that the markets give us this time around is small companies versus large companies, and that they do not always move together, exactly together. Talk about U.S. versus foreign. That's always a question of how much foreign to own. And in Q2, there was a major lesson that was a painful lesson in Q2. And then finally, just talk about the discipline of investing. It comes to real estate investment trusts. Everybody predicted 2018 that you wanted to sell REITs, and that did happen in the first quarter, but the second quarter things changed. So those are the major topics I'd like to discuss today. And so first of all, just the numbers, and as always, we'll send you a copy or a link to be able to view this presentation. The U.S. stock market was up. And this is really the Russell 3000, also mirrors the S&P 500, was up about 3.89% in Q2. This was after a negative Q1. So it came back in Q2. The developed markets, international developed was down a little bit less than 1%, 0.75. Emerging markets really were down quite a lot. And this happens with emerging markets. Very volatile sector. President Trump made some trade tariffs and other types of discussion around these issues, and emerging markets was, I think, hit by that narrative. Now, we don't know for sure. Usually we have price action, and then we come up with, when I say we, all human beings come up with a narrative to say why things went bad. We don't usually need a great narrative to say when things go well. Global real estate was up 6%, but really the story was not global. It was really U.S., and I'll share that with you in a moment. U.S. bond market, second quarter in a row that we've had negative returns. And so this is the price of the bonds as well as the interest payments that you're getting. It still came out to be, and this is the bond aggregate market. So it's about a 6-year duration, which means all the bonds turn over in 6 years. It pays an interest of, I'll show you that. I think it's a couple to 3% interest payments. And so we've heard for years and years and years that we were going to have bond markets were going to crash. And what's ended up happening in 18, interest rates have come up, therefore bond prices have gone down. But it's not really been a crash. It's just been, it's still, you hope that bonds will give you a positive return. But second quarter, they did not. And then global bonds, ex-US, again, diversification works. If you invest in global bonds, you had a 0.48% return. And again, these are quarterly numbers. So there was a pretty good amount of movement in Q2. This is all the messages that we heard. And in many messages, the yield on the 10-year government bond hits 3% for the first time. Oh my goodness, is this going to crash the stock market? That was the question. It didn't happen. Small caps set new highs, outpacing their multinational peers. NASDAQ composite climbs to a record. And then the U.S.-China tariffs that I mentioned before, and China sends yuans to fresh 6-month low. So inflation is a big concern. So all these different things. Now, if you pay attention to these every day and you invest on these things, you're going to drive yourself nuts. So anyway, it's best to just kind of ignore all these things. And so this is the long-term U.S. as well as world stock market. It's all markets, and so you can see that this last little bit, it's been fairly mundane when you go from one area to the other. Okay, so which classes did the best? Well, after a terrible, and when I say terrible, I mean terrible first quarter. If you sold out of U.S. REITs after the first quarter, you missed a 10% bounce back, either reversion to the mean or just whatever. But you missed a 10%. The Russell, 2000, which is small company stocks, actually 8.3%. And that's the value index. I'm sorry, that's value. The index itself, which again is small, did 7%, and then the larger companies did about 3%. And then you can see it's a story of the haves and the have-nots here, where all the have-nots are the bonds as well as all global, international, not global, international. Things that were not U.S. based were down a lot, and I'll share with you the reason for that, or one of the reasons for that. Again, we make the narrative after price. But U.S. stock market overall had a great quarter. I know we constantly hear, and sometimes we believe it ourselves, that, hey, the market's too high, it's not going to go up. The market's too high, it's going to crash. A crash will come. A correction will come. These things always do come over investment lifetimes. But again, we continue to tell clients that we do not know exactly what's going to happen into the future, but we know that if you consistently and stay disciplined, you're going to capture the returns when they come. And in the second quarter, the returns did come. Again, small versus large. Small did a lot better than large. And so I'm going to pause the video for a second and go to our other software and just show you something quickly with. Okay, so this right here, the green, is the small fund. Okay, it's a U.S. small cap fund. It's a fund that we use. In 2016, small had a return of 23.53%. That's pretty incredible. Now the S&P 500 had 12%. Not bad at all. And then this right down here is ex-US. So this is the rest of the world, developed as well as emerging markets, had a 5.45%. If you were diversified through all three of these asset classes, you probably did very well. But again, small beat large. Now, in 2017, the exact opposite happened. And so since we make our portfolios have some small, in 2017, it wasn't quite as beneficial to own small companies. They did 11.52 and large did 21.83. International, on the other hand, did 27.37. So this is emerging markets plus developed. So again, this is the power of diversification. If you stay disciplined through all these time periods, international does help you out at times. Now, as I said before, in 18, it definitely has not helped us out. International has hurt. So let me take away the Global Morningstar Market ex-US, which is foreign, and let's just talk about this large versus small. And let's go, we'll go 10 years first. Okay, so over the last 10 years, the small fund, the small index has beaten the large S&P 500 in a number of years. Recently, it's been a little bit less than it's been before. But over the last 10-year period, if you invested in one versus the other, small beat large. Let's look at 20 years. And this is actual data. This fund has been around. This was one of Dimensional Fund's first small cap index fund, or small cap fund, I should say. It's really a passively managed fund. But it did 500% versus 250% for the S&P 500. But the key thing here is that if you're going to invest in small companies, you are going to have years like 17 where the S&P 500 crushes the small index. And so there is a diversification benefit investing in small. The problem is the sin of diversification is that sometimes it's going to hurt you. But overall, it would have helped you tremendously if you had some small. Now, we're not saying have 50-50. We're saying come up with a good amount that makes you feel comfortable. Okay, so we're back to the slide presentation on Q2. Again, I find this stuff very interesting. You may not, but actually foreign markets, if you looked in their local currency, and this is the developed markets such as Europe, Far East, Australasia, in their local currency, they all have positive returns, okay? So growth stocks had a 5% return, 3.76, 3.61. So people that live in these foreign countries had a much different experience than we did in the U.S. because of currency. So in our U.S. currency, growth companies did 0.5%, and everything else, including small, was negative for the quarter. So this is the power of currency. And so this is, we do not hedge currency in equities. We hedge currency in bonds. But in short periods of time, this is going to happen. The last couple of years, the currency has been fantastic. And then in emerging markets, the same thing here. In their local Somebody I know likes to say the local funny money versus our funny money. Our money, sometimes is funny money too. But the growth did a negative 2.65. But when you take currency in for emerging markets, once again, the losses were much greater because we invest in U.S. dollars. So 11% of the investing world right now is in emerging markets. 35% is in developed markets, and U.S. market is now 53. It's climbed up since a couple of years ago, where it was about 50%. So the U.S. market continues to grow faster. This is the individual countries. If you're interested, Colombia and Qatar, we're the only emerging markets, and you can see Israel, Norway, Canada, Australia, US, and UK were all positive. Austria and Singapore were extremely negative. So anyway, you can check that out if you want. But this was the big issue for Q2 with foreign, and it happened at the very end of the quarter. Things were tracking perfectly fine with international companies until the very end of the quarter, where all of the countries' currencies became weaker versus the U.S. dollar, which strengthened. So that's what happened there. Real estate investment trusts, again, it was have and have-nots. U.S. REITs up almost 10%. International REITs were not down as much, so they probably had a positive return, but after currency, just 1/4 of 1% negative. Commodities, the big issue here is oil, natural gas, other types of energies have gone up. Many of the foods have gone down. So again, this might be a change in where returns come from. If commodities do go up, those companies that have commodities will go up as well. Fixed income, this is what I mentioned before about the yields now. Since interest rates rise and bond prices fall, actually the yield goes up. So if you're a retired person now, you can get 2.85 with U.S. Treasuries all the way to 4.15 if you invest in corporates. So it's a double-edged sword when interest rates rise, because in the future we get more money. So the impact of diversification, I talked about this before, but 100% equities, you can see over the last 10 years, 100% equities did 6.37. If you were 75% equities, 5.09. And we're going to get rid of the 2008-2009 market crash in our data coming up soon. So these numbers will jump once that data is out, as long as we don't have another market calamity. So this is just something that, simplifying things sometimes makes it easier. So event plus response equals outcome. And again, that's one of the things that we always try to discuss, is that there's all these events that happen in the market. And there's times when we think, well, this is doing better. Hey, Bitcoin's going to go through the roof. Well, if you respond to that, it's gone through the roof already, and you buy into it, then you can end up losing money. It's our response. But if you have a diversified and disciplined idea for investing, an enduring investment philosophy, which is what Charlie and I absolutely believe in, you'll have times when REITs will do 10% in a certain quarter after they've done very poor in the first quarter. You'll have times when international does very poorly in a quarter where it's done fantastic in other quarters. This is just the plight of investing, and this is really what we think is the greatest value that we can bring to investors as part of their financial plan, is to make sure we stay the course. We set up a discipline, we set up a portfolio, and we do rebalance, and we do make sure that it still meets your goals. But we're not going to jump around just because both news stories come out and data jumps around, and certain things return greater. So thanks so much for watching. If you have any questions about your portfolio, your investments, any of this data, please do contact us. So thanks so much for watching. Have a great